Yeah, let's get started talking about a pre-market plan. One of the most important things that you can have as a trader. Without a pre-market plan, you are pretty much gambling, right? You're pretty much going into the market without any real concept or idea of what you want to do, what trades you want to take, and that's when you fall into the gambling mindset and you start taking really bad trades and losing a lot of money. So I created this PDF for you guys, but this is something that I use. This is the what I go through, every single day when I am trying to find my high probability setups, right? So we are always looking for high probability trade setups. We don't want to take low probability. The reason I stayed out of trades this morning was because we had very low probability price action. We had maybe one good setup, and besides that, it was very choppy, range bound, just didn't want to trade it. And there's a few reasons, right? And we're going to kind of go through those. But again, how will you be able, what are you going to get from using this approach? Well, you're going to be identifying key liquidity targets, right, before the session begins, so you're not scrambling to find where you want to get out of your trades. You're going to look and actually recognize high probability trade setups, and you're going to get away from taking low probability trades in bad market conditions, all right? So that's what it's kind of, the whole idea is to get away from gambling, from taking terrible trades, and start taking really high probability setups. All right, so first step, are we inside of a higher time frame fair value gap? And this is what I'm talking about pre-market, okay? So we hop on the charts. Let's say it's 9:15 a.m. New York time. We've got about 15 minutes until open. Are we trading out of a higher time frame FVG? Okay, if we are not, then why are we taking a trade? Because typically when we do not see expansion out of a higher time frame fair value gap, we do not see any good trade setups, right? So what we want to see is either price already reacting out of a higher time frame fair value gap, or we want to see a trade into one of those fair value gaps at market open, right? So I'm always looking pre-market. Are we delivering from an hourly, a 4-hour, a daily, or a weekly fair value gap? Or is there one near us that we are going to trade back into? Okay, so basically, like I say right here, if price is outside of the fair value gap, you got to analyze it. You got to see, okay, are we seeking to go into that fair value gap to tag that level and then to go target liquidity, opposing liquidity, or are we already delivering from that, right? So I have a little example here, and we're going to go into some actual examples on the chart. So I'm not even going to go through this. It's kind of hard to see right now. We're going to go through the actual charts, right? But let's go through this next one. Do we have previous session liquidity? Now, we talked about this a little bit on Tuesday in my last video. But this is so important, right? Like today, we have Asia session liquidity, Asia high and low? Do we have London session liquidity, London high and low? Do we have previous day high and low? Do we have previous week high and low? These are the levels that we need to be looking for, okay? Because when we do not have these levels to target, we're typically not going to see a real reason for price to move in one direction or the other. So let's kind of look at today's example. Even though today was not the best conditions, we can still see that price was targeting a very specific level. So we actually had Asia low all the way down here, right, which was formed at 7:30. Remember, Asia session, 7 p.m. Eastern to midnight Eastern. So this was formed at 7:30. Okay, well, we have Asia low, so we actually have liquidity for price to target. And notice how we came back from the top of the range and we delivered to Asia low, right? So even though I didn't want to take a trade today and I didn't like our conditions, we can still see that price had a level to target, okay? We weren't just blindly, like let's say you did take the shorts, you wouldn't have just been blindly taking a short position. You had a real reason because we had previous session liquidity to target, okay? But then you have to go into, are we delivering from a higher time frame fair value gap? And today we weren't really doing that. We didn't have an hourly bearish fair value gap that we were delivering from. If we look at the 4-hour, we didn't have a 4-hour bearish fair value gap that we were delivering from. And that's why you saw me stay out of the market. We didn't have a daily and we didn't have a weekly. So I had no reason to be getting into the shorts because we weren't delivering. So one of the criteria was met, which was we had previous session liquidity. But for me to feel comfortable and to have conviction to take a trade, I need to see all of my criteria met, right? So since we weren't delivering from the higher time frame fair value gap, I stayed out of the market. Okay, so that is one of the key concepts, because most of the time when we are not delivering from that fair value gap, we're going to see a range. So even though we made a move lower, we didn't see too much expansion. And look at this range that we have, right? This is kind of just sideways consolidation, right? We had one decent move down to grab that Asia low. But besides that, we're just moving sideways. We're not really seeing any delivery. We want to see real expansion, boom, right? Really coming down or really coming up. And when we're not trading out of a higher time frame for value gap, you're typically not going to see us actually get expansion. Okay, so that's the other step, and that's why I stayed out of today's trade. Now we can go look at our next step. Step number 3, is there red folder news? This is also another really key concept that most people don't pay attention to. If we don't have red folder news, like let's say we don't have CPI, PPI, or whatever the red folder news is, that means we have a low impact in the market. That means we're probably not going to see too much expansion, because what drives this market most of the time, the volume is driven by when we have data come out, when we have a lot of buyers or sellers in the market. And typically when we don't have red folder news, there's not going to be a lot of buyers or sellers in the market. A lot of institutions are not really taking trades as much as you would typically see when we know we're going to see a bigger move, because that's when the money is made, right? So when red folder news is present, pre-market or whatever, expect momentum, right? On this example here, we had red folder news right when this started to dump and we saw a huge expansion, right? Or if we don't have red folder news, we're going to have lower probability. Like right here, we see leading up to that red folder news, the day before, we just saw a ton of consolidation, right? Not really any movement in the market. That's when we don't want to trade, because those are low probability setups. That's choppy. That's when we typically get stopped out. So again, we can look at our news today. Now, even though we had red folder news in the market, we still didn't see too much expansion, because why? We didn't meet our first step, which is delivery from a higher time frame fair value gap, okay? And then again, step number 4, we're talking about liquidity, right? Are we delivering from internal to external? Now, typically, the highest probability trades are going to be delivery from internal liquidity to external liquidity. Now, there's still going to be trades that are good that deliver from external to internal, but usually when we're looking for expansion, we want to see an internal sweep that's going to target external. That's typically when we see our biggest moves with the most reward in the market. Okay, so again, you can still catch good trades from external to internal. I'm not saying it. It's just typically lower probability than you would see from internal to external. So like in the example here, we had an internal swing high up top and we had an external swing low down here. So we come up, we sweep internal highs, and then we target external, right? And why is this important? Because typically on the higher time frames, we're going to see more liquidity resting above or below our swing lows and swing highs compared to our 1 minute, 5 minute, 15 minute. Yes, while it is still liquidity, it's not going to be as strong of a level. So we want to find where our external levels are on the hourly, the 4-hour, the daily, and the weekly time frame, right? That's going to be our really key levels. And typically those levels are going to show up at previous day low, previous day high, previous week low, Asia high, Asia low, and so forth, right? It's typically when we're going to see our external liquidity. So let's say I wanted to catch a short move, because look at right here, we have an hourly swing low. Let's say I wanted to see price come down for this hourly swing low. It's an external liquidity level down here. Okay, so what am I looking for to see that move come down? Well, I want to see an internal liquidity sweep first. You know, like here, we come up and we sweep internal liquidity. Now, I'm not saying this is a trade I'd want to take, but just for an example purpose, we come up and we sweep internal liquidity right there, and then we'd want to see delivery down to our external liquidity below. But remember, what step are we still missing? We're not delivering from a higher time frame for value gap. So let's say right here, this was actually a 1-hour bearish for value gap right here. I would have so much more conviction, right? A 1-hour sell side imbalance, buy side inefficiency. If this was a tag of a 1-hour bearish for value gap, I would have so much conviction to look for the shorts, because again, it's my GUI model. We sweep internal highs, we deliver from a higher time frame for value gap, and then we inverse a 1 minute bullish for value gap, and we have external liquidity resting below. That's the model right there. That's the type of trade we want to take. But if we're just sweeping internal liquidity into no fair value gap on the higher time frame, we're not delivering, there's no reason for me to be taking that trade. And as you can see, we're just kind of chopping around. While it is lunch hour, usually we do get a lot of chop in lunch hour. Still, even when we're not in lunch hour and we see something like this, I don't want to be trading that, right? So that is our step number 4. we really want to be looking for internal to external liquidity to see more expansion moves. Typically, external to internal liquidity are going to be more shorter trades, more scalps, right? So, what is this checklist that we have to go through every single morning before we take a single trade? Let's do a quick recap. Number one, check for higher time frame fair value gap reactions. Now, you can look at order blocks as well. I typically like to look at my fair value gaps the most. I like them more than using order blocks, but you can also use order blocks, okay? Step number two, identify previous session liquidity zones like we talked about. Step number three, look at news. Do we have red folder news? Do we not have red folder news? If there's red folder, we're going to see more momentum. If there's not, we're probably going to see lower probability chop. And then last step, ensure that price is delivering from internal to external liquidity. And like we talked about in our precision entry lesson, that's when you're looking for the entry model to actually take the trade, right? Once the market opens, once all of these steps have been checked off, now you're looking for the actual entry model to execute your trade. So this is what I go through every single morning. And you should really download this PDF. You should have this in front of you, maybe on a piece of paper, maybe it's on your computer. That way you can circle or cross off all of these steps before you take a trade. Because I'm telling you, if you actually do that every single day, your likelihood of taking high probability trades and being profitable goes up so much. If you do not take these steps seriously, you're going to get caught taking a lot of low probability trades. You're going to get stopped out of a lot of trades. You're going to take a lot of losses, because this is the key to finding the highest probability trades in the market, to finding profitability and being consistent. We can talk about bias a little bit because we want to know how to find bias. Well, it coincides with that pre-market plan, right? I don't have a bias if we're not delivering from a fair value gap. If we don't have external liquidity to target, that means we're probably going to range, so I just have a range-bound bias. But if we have obvious liquidity to target and we're delivering from a higher time frame fair value gap, that's going to give me a really good daily bias. I'm going to know where price wants to go for the day, right? And we can kind of go back to previous examples, but I knew I had a bearish bias up here because we're delivering from a higher time frame fair value gap and we have external liquidity resting below, right? And we can look at so many other examples in the charts of this fact, right? Look at here. We retrace into a 4-hour fair value gap. We have external liquidity at a 4-hour low right here. Boom. Once we start delivering from that level, we know our bias. We know we have external liquidity. We look for our entry model. We take that trade, right? You can't have a bias if you don't know what levels we're actually trading from. You're not reading market structure. You're not going to know what to do. You're not going to know where the day goes. Now, I would say that I probably know where the market is going to go on the day, 80 to 90% of the time. There's going to be days where I have my bias wrong, and that's fine, right? And typically when I have my bias wrong is when we're not delivering from our higher time frame for value gaps. That's typically when I don't have the right bias. But I would say the reason I have, a really, really good grasp on daily bias and our draw on liquidity is because I'm looking at these higher time frame levels, because I've spent thousands of hours on these charts understanding these concepts. And once you know where the day is going, that's when you just have to go back to that precision entry lesson that we did on Tuesday and go back to that precision entry PDF. And now okay, when I mix my pre-market plan with a precision entry checklist, I am 100 times more likely to catch profitable trades than I was before.